Okay, I'm going to start recording now. And guys, again, officially welcome to our live, not your average financial podcast and Grandma's Wealth Wisdom co-episode. I'm super excited to have you guys here. You're already not so average if you're doing a financial webinar on a Saturday morning. So way to go already. You guys are brilliant. Congratulations. You're already the weird ones, and we love hanging out with the weird ones. So I'll just kind of kick us off by officially sort of running through why we decided to do this and who this might be for and who it's not for and sort of what we'll be covering together. So again, I wanted to start with some questions. I mean, did you know in February of this year, 2020, we're recording this late April, but did you guys know just in late February what you know now about the world economy? Could you tell in advance that there was going to be a virus that would shut down the world's largest economies? Does it bother you that your financial future might be tied to invisible things that you cannot see, you can't expect, you cannot control? I mean, just step back for a minute. If this is a one-off market collapse, that'd be one thing. But is it part of a regular pattern of financial abuse? Is this what the stock market might be like in the future? Is it what the stock market has been doing even in the past without us even really realizing it? So, the average financial advisor is going to look at average returns, the stock tickers, ups and downs. But what we're going to cover together today is that that's a fairly dangerous and unhelpful way to predict your outcomes, predict your future wealth. So we want to talk some about a not so average way to evaluate Wall Street. And we think some actions you can take to antivirus your money and make you financially immune to any recession that we have now, if we're in one right now, and also ones that might be coming in the future. I mean, think about it. We want you guys to know the truth. And if this recession pattern has happened now 3 times in the last 20 years, what's the likelihood you might experience another couple over your lifetime? So we're going to be covering a lot of ground. I think there's going to be a lot of questions to ask. So just to give you guys some quick pointers on what you can do to participate, because it's always better when you're here with us, please write your questions down. And there's a toolbar on the, I believe it would be on your left side of your web browser as you're listening to this. Write your questions as you have them. Don't wait for us to ask. Go ahead and jot them in there. And you can send them to the organizers, so it's only us seeing them, or you can send it to the whole group if you'd prefer that. And Brandon will be helping manage those questions and maybe even answering them in real time. Thank you, Brandon, for that. But there may be a chance for us to read your question aloud for either me or Amanda to also answer. When we come to certain points in our presentation, we're going to stop presenting and we're going to have your questions answered. So bring those questions. And unlike Super Chat on YouTube, we won't even charge you to ask a question, okay? Unless you really want us to charge you to ask a question. The other thing I'll mention is we're going to have a few polls that we'll be sending in because we do want your participation. We'll be really curious as to your thoughts. And I've sent Brandon 2 polls that I'd like Brandon to send out throughout the presentation today. But Brandon, feel free to write your own or add more to it. And if I need to add those polls and generate that first and foremost, I can do that too while Amanda's doing some presenting. So with all that in mind, we will have time even for you guys to come on live with your voice to ask a question if you want to. And there may just be a special prize waiting for the folks that come on live and add your voice to the conversation. Any other bits of homework, Amanda, Brandon, before we dive in?
I think the one thing I would add is if you are putting this up in a tab in a browser, maybe make it the only thing that you have open, silence your cell phone, put things away. We put a lot into today's presentation. Like there's a lot of information. I don't want you to miss something that could be really transformative for your financial path. So please stick with us here. We'll try to be really quick. Honor your time and make sure that you get a lot of value out of it, but only if you pay attention, right?
That's true. Very true. Good. Well, with that in mind, Amanda, are you good to go? You ready to rock and roll?
Ready.
All right, cool. So let's see. I want to start with, of course, our disclaimers. And Amanda, your mouse is there. Are you able to kind of move the mouse a little bit, or is it stuck there?
Yep.
Oh, okay, right on. Cool, thank you. So we want to keep the lawyers happy, so we're putting all of our disclaimers at the very beginning. Of course, we're not accountants. We're not investment. We're not looking at your investments. We're not going to be giving you specific investment advice today. Sorry to disappoint if you wanted to know which hot stock to pick or whatever. And we're also going to be talking through some solutions that I think have some built-in real wealth building strategies. But we want to get into, first of all, the problem first. So let's go on to the next slide. I would say that the biggest and most troubling part to this financial calamity that we're going through is 5 problems of average thinking and 5 problems with investing. So that's the big picture overview of what we're going to cover together today, guys. And the main concept, the big, fat, juicy idea we want to get across to you is that market turbulence is not going away. It sure feels like this is the first time we've gone through a major market correction, a viral attack on our money. But we were financially infected way before this most recent global pandemic started. We were financially infected maybe for decades, maybe even longer than that. And we want to talk about ways you can antivirus your money, where you can actually know for sure what your outcomes will be every step along the way. So that's what we hope to cover in our time together today. So let's start with the real problem. The real problem. Now, most people would think, if you're a longtime listener of either of our shows, you're going to maybe presume that biggest problem is Wall Street. And I'm getting some sort of echo here. I'm not sure what that echo is. Hey, Brandon, are you hearing that echo too? You might put your headphones on there. I'm not sure if you're getting that echo or not, but oh, it's gone now. Can you guys still hear me okay? Brandon, you good? Amanda?
Yep.
Okay, cool. Right on. Okay, so since the start of the year, we've been seeing some really volatile market swings. In fact, it's been the most volatile the market has ever been in its entire history. I mean, let that sink in for a moment, guys. That's so huge. We actually had the biggest day-to-day gyrations since the start of the stock market. That's a huge deal. But even so, that's not the real problem. The biggest problem was not investing on Wall Street, although I bet you didn't think we'd say that. Here's why. We could handle the market's volatility if we had a massive amount of money saved. We could handle that massive gyration of the market if we had a big stockpile of money. If we had a huge wad of cash, we're going to be making a distinction between saving and investing in our time together today. So there's a difference in the definitions in my mind between saving and investing. So for a moment, just to try out the Q&A section, guys, think through that statement for a minute. What is the difference in your own mind between the word saving and investing? So go ahead and just write something into the Q&A box, and Brandon can feedback. And Brandon, if you see any responses to that question, I'd love to know what folks say. What's the difference between saving and investing? I heard somebody say risk. Someone else said savings is an emergency fund. Brandon, are you seeing those too?
Yes. So my headphones are not working right now, so that's why the echo, I think. So I'm keeping myself muted as much as possible.
Okay. Amanda, do you see any of those questions and answers there? Length of time and risk?
Yeah, savings is fixed, no risk and liquid money. Investing is money you're okay to lose. Investing is long-term. I wonder, is saving long-term too?
Interesting stuff. Yeah, great stuff. I love it, guys. Store of capital. Thank you. So we've got Colin. Thank you for that. Thank you for your response, Christy. Investing is long term. Michelle, investing is money you are okay to lose. Beatrice, thank you. Length of time and risk. Very good stuff, guys. Thank you, everybody. All right, so we've tried out the Ron. Thank you. Yeah, savings equals storing. Investing is about growing. Interesting stuff. Okay, true compounding of wealth. Thanks, Jeff. Well said, everybody. Well said. Well, we've got some financially not so average folks listening to Grandma, right? Okay, so again, we could have handled this volatility if we had a ton of money saved. But even before this crisis began, we were already in a massive amount of trouble. We didn't have a rainy day fund. We couldn't have handled a drizzle, and this crisis gave us a torrential downpour. So Americans have, on average, $6,500 in credit card debt, according to Experian, that just came out late last year. And that's, but with the expenses that are adding to the balance of their books, it's actually a full 23% of Americans say that paying for basic necessities such as rent, utilities, and food is what contributes the most to their credit card debt. And another 12% said medical bills are the biggest portion of their debts. So that's a statement of real interest to me. I mean, the gap, that's not like they're going out and buying flat screen TVs. They're running up their credit cards to cover those basic living essentials, right? So there's some sort of a gap between the standard of living and real disposable incomes. And this chart that we'll show you on the next slide, I think, really clearly shows this. So beginning in 1990, income alone was not able to meet the standard of living. So consumers started to turn to debt to fill in that gap. However, following the financial crisis, even the combined levels of income, so husband and wife, two incomes in the household, they're both working and fighting and scratching to get some income. And even so, a two-income household is no longer able to fill the gap. And currently, there's a $3,200 annual deficit that cannot be filled when we're looking at the cost of living and the sort of the consumer's needs to make ends meet with their income. So this is the gap between the income needs and the cost of living. So the debt per individual and the cost of living. And this has actually been happening for a very long time. Since the late 60s, we've started to see, and in early 1990s, we now no longer have a standard of living that can be met with our income alone. So we have to go into debt just to cover the bills. So as you can see with this, even before we ran into this current financial meltdown we're in right now, we were already living way beyond our means. Debt was up, auto loans were up, student loans were reaching a record high, even before 2000 rang in the new year. So you can, which is why you can you can see your consumer credit hitting an all-time high. Just as we were entering the 11th year of the bull market, even with rising wages and historically low unemployment, back when we had low unemployment just 2 months ago, 3%, we were spending everything as if the sun would always keep shining. Amanda, what do you think about businesses?
Yeah, I think if this is true for individuals, I think it's even more true for businesses. I ran across a survey that was asking small businesses about their cash flow, and 50%, so half of the firms that were surveyed, had had 2 months or less of cash to operate their businesses as of January 31st of this year. And those, the survey authors noted those limited levels of cash on hand readily explain why they had to do layoffs and shutdowns, and why those have been so prevalent. Half of businesses not being able to have 2 months of cash on hand. And of course, this is going to vary by industry, right? One of the things I found really fascinating about this survey, 38% of all the firms that they surveyed said that they'd still be open if the crisis lasts 6 months. That's a lot. Only 38% said they'd be open. That's a little more than a third. But when you look at tourism and lodging, it was 27%, 15% for restaurants. Of 100 restaurants, only 15 would, thought they'd be open for after 6 months. And of course, entrepreneurs are very optimistic. So the true survival rates could be even lower. And I think, so in other words, many businesses are going to fail during this crisis because of a savings problem.
So true. Yeah, it is a savings problem. Wall Street didn't create this problem. A virus didn't create this problem. The problem was savings. And so, I see that as a huge problem. There's a second problem, though. Let's jump into that next. The second problem is flawed advice. So the media loves to put out feel-good information like the following. They might say, let's create a fictional character. Let's go back over this person in today's webinar. We'll call him John. And here's what the media would tell John. They would say, quote, if you start saving, and they use that word, at age 23, for instance, you'd only have to save about $14 a day to be a millionaire by age 67. And then they go on to say that they got those numbers by simply assuming a 6% average annual investment return.
Yep, that's the typical advice out there. And I think as we go along, we're going to see why that doesn't necessarily work. And also, I'd add to that how many times we've heard someone say, don't open your 401k account, or don't look at the balance. Or if you do look at the balance, don't worry, it'll come back. It always comes back.
Mm-hmm.
And if those words don't sound like flawed advice to you, I hope they do by the end of our presentation today, that you can see what's really flawed about that way of thinking.
Yeah.
And if you've heard those, put those in the comments. If you've heard that advice, put yes, or I've heard that, something like along those lines. Love to know if we're the only three that have heard that advice.
Good stuff. So while we're going on there, yeah, I think that is sort of the average way of thinking. And you're right. I think there's sort of a flawed assumption in that. But let's dive into why that's flawed. Why is that such a problem? And why does that cause us to have a savings problem? So the third savings problem I see, the third problem is that markets don't compound. So let's assume for a minute that John or you or I follow the average advice, and you want to compound your investments by 10% a year over 5 years. And so, Amanda, are you able to show on your screen the chart? Okay, it's up. Great.
Yeah.
So let's talk through this chart for a minute. So in the first year, that's represented by this chart here showing a 10% annual return. In the second year, you have the same 10%. Great, we're doing great. So the average between those 2 years there is 10. And that's why you see 10% there on the right side of the table. I hope everyone's with me so far. Third year, no problems. We're still kicking out our average 10% return. But in year 4, we drop by 10%. Wait a minute. 1 year of loss effectively destroys the compound rate. Now we only have an average of 5%. But wait a minute. We had 3 years of 10% standard rate of return there every year. It only took one negative for us to cut our average return in half. Can you imagine that for a minute? Going from 10% to 5% just because of one measly year, down 10%. By the way, according to the last 100 years, the stock market on average once a year, at least temporarily, goes down by 14% every single year, 14% drop. But let's say that this annual return is negative. What would it take to get back up to your 10% average? Well, some people might say, well, I'd maybe 10% positive again. Other people might say, well, I need to double my return. I need to get 20% to get back up, right? I lost 10, so I need to get 20 back. And you're on the right track, but the math works out where it would require a 30% return to regain the average rate of return that you require of 10%. It requires a 30% return to recover from a 10% loss. Huge.
Yeah, and in reality, like chasing those returns, I think is much less important to your long-term investment success than most of us believe. But I might be jumping ahead to part 2 with that statement. So hold on to this idea of how does compounding really work? Keep that question in mind.
Mm-hmm. Do you want to say anything more about that, Amanda?
Yeah, actually, I think that's we're going to be looking at that a lot. I think it's interesting. Someone put a question in the Q&A or a statement. You have to know where and how to invest to get the compound return. And that makes me think, oh, there's going to be stocks that I'm never going to see a negative. I'm always going to see a positive, and that's going to compound for me. But I'd love to know if there's ever been a stock that never had a negative, right? And if you can find that, like that, yeah, let's invest there. But if we can't find that, then maybe we need to look outside the market for where we can get true compound interest.
Absolutely. Yeah. Yeah. If there's ever a negative, we break compound growth. It doesn't matter if it's, it doesn't matter if it's a stock, a bond, a mutual fund, or anywhere. If you ever break $1, you've lost that compound growth for the rest of your life. And let's see that in reality. So, when you're factoring in volatility, and that's the key word there, volatility, when factoring your volatility into your returns, there's going to be a huge difference between what investors receive and what real let's say, okay, so yeah, what your real results will achieve. So this is the huge flaw in average financial planning. Okay, so let's say, for example, you're young, you're just starting out in life, and you're ready to invest $10,000. Okay, so there's your $10,000 on the chart there. And let's say that you walk into your financial advisor's office where you're going to be promised an average return of 7% over your lifetime. The OSO average financial advisor shows you how the market has done 7% average since 1965 up until right now, 2020. And they show you this wonderful, beautiful chart. The black line is the real S&P 500 returns since 1965, and they draw that nice, straight level line there that's ever increasing, and they write average return equals 7% right there. And they convince you, let's say, she projects that 7% could reasonably continue into the future through your retirement year. So that might be 2060 if you're a young kiddo just getting started. So her average 7% return produces this beautiful orange J curve sloping up nicely and beautifully up and to the right, if you see it there on the chart. And she says, hey, there's your money right there. Look at that. Now, pay no attention to the S&P. She says, don't look at it. She says, just ignore it when the market drops. So with the actual S&P 500, rocking and jostling up and down, you can see that the projected S&P as an orange dotted line continues on in a similar market with swings and gyrations. But we're not going to be doing an average 7% over our lifetime. The investment advisor, says that even if you put nothing else but your $10,000 into my wonderful investment account that I'll manage for you for the next 40 years, even if you touched it never again, if you never added another dollar, your $10,000, and here's her math, she'd say, here's your $10,000 over 40 years would grow to $149,000. Of course, she'll want you to save more, but you've heard enough. So you leave the office, you buy into the beautiful J-curve picture, and you write the check to invest $10,000 into her S&P 500 index fund. And the lump sum begins to grow alongside the index. And you totally forget about your $10,000 for the next 40 years. You have in your mind, you're going to get that $149,000. But the OSO average financial advisor forgot one very important piece of the equation. Promises are not the same thing as reality. And averaging is not the same thing as actual reality. It's like our kindergarten teacher said, guys, nobody is average. Everyone is special. Nobody is an average statistic here. So let's fast forward 40 years now. You can see the blue line, the actual growth of $10,000 is far short of that beautiful orange line there. And sure enough, you receive your financial statement in the mail 40 years from now. As you're approaching retirement, you finally decide to open up your account statement, and you still remember that $149,000 you were promised. And sure enough, your rate of return on the front page of your account statement in big bold letters says 7% average rate of return. You get excited. You get ready. You turn the page over, your account statement. You're going to find that present balance of your investments, and your jaw drops. You only have $48,000 to your name. How is that possible? Well, if you're seeing the screen here, you'll see the spreadsheet. And by the way, if the video is in the way of any numbers, you're actually able to click and move that video around if you need to. But as you look at the calculations, the numbers are dramatically different. Why? Because your true return due to volatility was only 4%. That's the real return, something called the compound annual growth rate over the last 40 years. According to this chart on the previous slide, that blue number was beat up by volatility. And so instead of $149,000, guys, you only have $48,000. You're shocked. And you let that account statement drop to the floor in your kitchen. You run out the door. You drive to that financial advisor's office. You bang on the door. You demand to know where is your missing $100,000. And of course, unfortunately, your financial advisor has long since retired, having enjoyed 40 years of managing your money and taking fees off that money, which were not even factored into these numbers, by the way. If she had actually been taking money off this account, you would have had even less than the $48,000. Any feedback or thoughts on that problem, Amanda, of volatility?
Yeah, it's just so true. And yeah, we've just scratched the tip of the iceberg with talking about volatility. You're absolutely right. We could have talked about the fees, right? And the money that gets taken out, not just by the investment advisor, but by the fund manager and the fund itself and all of those things. Yep.
Mm-hmm. Yep. Good. Well, okay. So the fourth problem is $1 million sounds like a lot, but it's not. What's the millionaire lifestyle these days, right? I get it. $1 million sounds like a ton of money. It's a big, fat, round number with a lot of zeros. And in 1980, $1 million, the millionaire lifestyle would have generated between $100,000 and $120,000 per year due to the interest rates and the situation we were in the early 80s. While the cost of living for a family of four was just $20,000. So you could live on 20 grand a year, but your investments were going to be doing 100,000 to 120 grand a year. That's awesome. That's like perpetual wealth right there. Today, however, there's a massive shortfall. There's a $40,000 shortfall between the income that $1 million could generate and the cost of living that we all have and expect today. So, just as a rough calculation based on historical averages, the amount of money you'd need in retirement is based on what you think your income needs will be when you get there and how long you think you have to reach your goal. So Amanda, talk to me a bit about this. What are you seeing on this?
Yeah, so this chart here, you see while the line up here is above zero, that means $1 million would provide the amount of money that you need to cover the cost of living for a family of four. And then when it goes below zero, it doesn't cover that. Is that what we're seeing, right?
Mm-hmm. Yep.
Okay. And of course, I immediately think of the FIRE movement, and they would say, well, my average cost of living for a family of four is way lower, right? I live in a tiny house. I sacrifice all the luxuries, reading rice and beans. And, that certainly is an option that lots of us could think about doing. But I think there's also lots of us who think that, as we get close to retirement and are living in retirement, maybe if that's not early, it's later, right, in our 70s or 80s, we might think, well, we're just going to stay in the same house and never go out, much like this quarantine lifestyle right now. We think this is what retirement's going to look like. But we don't consider the medical costs alone, which some experts say are going to cost $500,000 just to cover medical expenses and nursing home expenses if we end up needing that. And so, sure, we can think about, I might not spend as much in retirement just on lifestyle, but you might have to spend more on medical as well. We have to factor that in to what, not only the lifestyle we want, but also the things that we don't really choose, but that we get stuck with.
So, Amanda, you're saying, we need our lifestyle to be paid for from our savings and investments over the working years of our life. But what I hear you saying is most Americans don't have $1 million altogether. And you're saying, in addition to our bucket of money we'd need to have saved, we need other categories for eventualities like a health emergency or long-term care that we don't have set aside or we don't expect to need that money. And unfortunately, the statistics are we will need some additional cash just set aside for nursing home expenses, etc.
Yeah.
Wow. Okay. So again, it's a problem of saving. It wasn't, Wall Street didn't create this crisis. A virus did not create this crisis. It had been, it might have been the pin that popped the bubble, but it's not the bubble itself. We had an infection from years ago. So, if there is a desire to live a similar or better lifestyle, guys, we're going to need a lot more than just $1 million. Our kids, our bigger houses, our education, our cars, all of our smartphones, all the things that we now expect are part of why we have the biggest in the United States. We have the largest retirement savings gap in the world. Again, let that sink in for a minute. First world country, most wealthy nation in the world, but we have the biggest gap between what we should have and what we do have in the entire world. So if you're in the latter camp like me, $1 million just is not going to cut it, for the lifestyle we want to enjoy into our golden years. So if it's not $1 million, what is our magic number? What's that special amount of money that we're going to need to have in order to retire? Well, CNBC recently ran a study discussing that magic number idea, saying that there's going to be a target for some folks who want to have a point where they can achieve financial independence. So, how do you describe that, Amanda?
Yeah, we call this the FIRE number. If you're talking to a FIRE movement person, it's what do you need for financial independence? And typically, that in the average way of thinking, what CNBC would say, as well as many other people, is that it's equal to 25 times your household annual spending. So if whatever number you need annually to cover all your expenses, multiply that by 25 and make sure you've got they would follow that up with make sure you've got that amount invested in low cost passive index stock accounts, index funds. And usually that's between, if you're just looking at the average American, between $1 and $2 million is what you end up getting when you do that math and you multiply out by 25.
Okay, got it. So, their aim is to have 1 and 2 million. But what about you guys? Again, if you raised your hand and said, yep, I could live on $25,000 a year, that's awesome. First of all, way to go. I don't know where you're buying your toilet paper and groceries these days. But what if you factor in 25 years of inflation? If you needed $25,000 a year for the next 25 years, you'd need $1.2 million just to eke out that existence of $25,000 a year. So 1.2 million, that's 20% more than you'd planned on saving if you lived on just a raw 25 grand. That's the millionaire lifestyle today, is $25,000 a year. My bet is that most people on this webinar want more than $25,000. It's probably at least a desire to keep up with your current lifestyle, keep up with your current salary level, maybe even give yourself a pay raise once you retire. But the trouble is we're going to need to have a ton of money saved up to be able to hit those results. Amanda, take us to the next slide here, and I think we'll see it. This is built on the very aggressive 4% withdrawal rule, meaning if you want to withdraw $100,000 a year of your investments, on the day you retire, you'd need $4.7 million, $4.7 million that you'd spend, and you'd need to have saved $2.5 million to get there on the day you retire. So that's what you'd need to have ready to go. And that's like you'd spend $2.5 million. Excuse me. Let me read this again. So if you wanted $100,000 a year of salary for 25 years, that's $2.5 million that you'd spend. But to keep that standard of living for 25 years, you'll need to have spent 4.7 and saved $4.7 million that you'd need on the day you plan to retire. And if you want a $200,000 salary, that's $5 million that you'd spend over your retirement years. So on the day you plan to retire, you'd need $9.5 million saved up. To me, that's just looking with clear eyes into our future. So that is a giant number by any stretch of the imagination. But unfortunately, we're just not accounting for the future cost of living. And not doing that is going to leave most individuals living in tiny houses, eating a lot of rice and beans, whether they like it or not. Not that there's anything wrong with tiny houses and rice and beans, but if you want something more for your future and you knew you could make a difference toward it, not that hard, would you take that step? And I think we've got some solutions coming up. But first, any final thoughts on problem 4, Amanda?
No, it's a big problem. And I think the final problem just compounds on here.
Yeah, so true. So that problem number 5 is don't forget the inflation. There is volatility. We have annual compounding problems, but we do have annual compounding inflation. That's one part of our portfolio that always compounds. So if investments never compound due to ups and downs, the problem is inflation always compounds. It never has, at least in my lifetime, we've never had deflation. And I don't see that happening personally anytime soon, although I could be wrong. So we have had for the last 40 plus years, almost 50 years now, inflation every single year. And the average financial media would like you to believe that it's easier than baking a cake to outpace inflation. Let's go back to John, our example with Mr. John. Let's say he's 23 years old. He's earning 40 grand a year. He's going to do that $14 a day that CNBC tells him to set aside. And so at age 67, he has that wonderful, magical $1 million, assuming he actually gets that 6% average rate of return, right? And so he's going to follow, again, the average advice of withdrawing 4% of his retirement money and live on 40 grand a year of annual income. Pretty straightforward, right? For 4% of $1 million, he's going to take out 40 grand a year. The problem is that's totally wrong. It's totally wrong on so many levels. Let's talk about the math. Let's see if John can do the math on this. It's not difficult, but it's just something that we're not typically shown or taught through. So let's talk about the math. The living requirement in 44 years is going to be based on today's income level, not the future income required to maintain his current standard of living. In other words, he's going to need to live on more than his current salary of $40,000 a year when he's 40 years older because of inflation. In fact, because it's based on his current income level, 40 grand today won't buy the same stuff in 40 years, right? So if we go forward, let's just look at a 30-year inflation adjusted income level. If you're making 100 grand today, that equals $190,000 in 30 years. So this is based on average inflation rates of the last 2 decades of 2.1%. But guys, has anyone even been able to keep up with how many trillions of dollars have been printed since February? I mean, do you think that might impact inflation? So if the inflation rate goes higher than 2.1%, we're going to need even more money to spend in the future. These numbers all get bigger if we have more and more government inflation. So let's presume for a moment the other problem, which is the 4% rule. The Wall Street average investment advisors tell you to take 4% of your money out each year. Amanda, show us that slide next. So if you need to fund a lifestyle of $100,000, this one here, perfect. Yeah, back to this one. If you need to fund that lifestyle of 100 grand or more, you're going to need $5 million in retirement. $5 million on the day you plan to retire. So walk us through some of that math.
Yeah. So this is what it all comes down to. So at age 23, John lived on $40,000 salary. If we have, for projecting for inflation, that means in 30 years when he's 53, which lucky him if he gets to retire at 53, but we did the math for 30 years. So we kept it at that. He'll need instead a $76,000 salary to maintain that same lifestyle that 40,000 got him at 23. Maybe he's got kids at 73, he's got to put through college, so maybe he needs more, but let's pretend he doesn't. And you multiply to find that freedom number, you multiply by 25, you get 1.9 million. That's almost, remember, he was saving only $14 a day. He had $1 million saved, but he finds out he actually needs 1.9 million to live with the same lifestyle he had when he was 23. How do you think John is feeling about that $14 a day that he's been saving diligently for 30 years?
Somebody pulled the rug out from under him. Yeah. What do you guys think? Put some comments in the question and answer section here. B writes, looks like I'll be working for a long time. Amanda, thanks. I think you wrote, don't worry, we'll provide some solutions too. I think that's super cool. Yep, you're right. We've got some answers to all these problems, I promise, guys. Okay. Brandon, are you still on and available to read some of these?
Yep. Probably wish we'd saved $28. Is what somebody said.
Yeah.
It's is multiplied by 25 because that is the expected life expectancy. That's what Beatrice asked. So can you answer that? Is it multiplied by 25 because that's his life expectancy, or how did you come up with 25?
That is again, kind of a general rule that the average media would purport. And you can also, what is it? I think you can divide by 25. That's the 4% rule through multiplication. So you can either multiply by 0.05 or you can divide by 25. Either way, you get the same answer.
Gotcha. Yep. Great.
A little bit of math on a Saturday morning. I promise we won't make you guys do any math.
No other questions right now. If you guys have questions, we are going to be coming back to them at the end too. So,
and I would like to ask too, if anyone would like to come on and speak your question aloud, again, we will be giving a special prize to the best verbally asked question at the end. So have your hands up. The way to do that is on the toolbar, you can raise your hand. And if you raise your hand, Brandon, I think, can help bring you on and allow you to talk. And again, if you've got the best voiced question, we will give you a prize at the end of the presentation here. So,
and Mark gives good prizes.
That's right. That's right.
Craig Wright did raise his hand.
Yeah.
I'll
let you take it, Brandon.
I'm going to figure out how to add him.
So we are done going through the problems here for saving. Let's see if we can get anyone to give any comment or question to the 5 problems we just listed. There's also a poll. You can write your answers to the poll.
Can I speak now?
Yep. Craig is here.
Great.
Can you? We can hear you, Craig.
Oh, okay. Yeah, cool. Oh, all right. I'm just looking for basic lifestyle. Nothing fancy. Still want to, do some traveling here and there. So the math. How much would you need just to maintain a basic lifestyle?
Good question, Craig. Amanda, do you want to pull that chart back up one last time?
Yeah. Which
the one about inflation adjusted income.
Oh yeah, this one.
Now, this is going to startle a lot of people, but the lifestyle needed. Oh, one more, or maybe 2 back, I guess. Yep, that's the one.
This one.
Nope, keep going forward to where it shows that one there. Yep, the amount needed at retirement, 4%.
Okay. Yep.
So to live on 25 grand a year, you'd need 1.1, almost 1.2 million dollars saved. Now here's some good news that we're going to get into next. Don't forget that as of this recording, Social Security is not broke yet, or at least they're not saying they're broke yet. So that can help support a simple lifestyle if need be, guys, in the future. That'll help support these numbers. And we're able to create financial strategies today that can help you achieve these numbers without taking unnecessary risk. So thank you, Craig. I'm going to put the results of the poll that we asked visibly for you guys to see it as well. Can you guys see the results of the poll? So we asked which of the problems we just went through most resonate with you.
Oh, the poll?
Yep. So I'll say the list of the poll there should be visible to anyone who wants to see it. And thank you, Craig. I guess we'll move on now to the solutions, but there's some really powerful answers you guys have given. Amanda, do you have any quick feedback on the answers are you able to see the results of that poll?
Yeah, I can see that. Very interesting. Yeah, the flawed advice really sticks out to me. That would be it just shows that people are listening to your podcast, Mark, that they that they know that problem exists, I guess, is what if and they feel that problem. They hear it all the time.
Yeah, I think it's just remarkable to me, and I'm so proud and so excited to be working with the folks on this webinar. And we do have some powerful solutions, not just problems. So we've kicked over a few sandcastles, Amanda. Why don't we talk about some strategies? We have a few more. Then we have a part 2 where we get into some more problems and then some more solutions. So this is the first section where we're going to get into some solutions. So let's take action. How we can be better than average, how not to be average, let's say. So our first step in taking action is to pay yourself first aggressively. And someone brought it up. We need to be saving $28 a day. I think that's a great answer. And start with 28 and then move up to 30 if you can. Just start where you can. Be aggressive and grow from there. 30% of your income is our rule of thumb. So,
yeah,
Amanda, talk to us about the 10-10-10 rule.
Yeah, we saw how for John, saving $14 a day didn't get him to where he needed for retirement. And that was when we did the math, 12.8% of his gross pay, the $40,000 that he was making per year. I really love Grandma's 10-10-10 savings formula. I've been using it myself for several years now. And the rule of thumb there is 10% for short-term savings, 10% for medium-term, and 10% for long-term. Short-term are things that happen at least annually, if not more than frequently than annual. So we're talking about holiday gifts, summer vacation, the oil change, car maintenance, that kind of stuff. Medium term would be like replacing your car, replacing your roof, things that happen maybe once a decade or so. And then long term is really what we're thinking about, like retirement savings, something that's going to be there for you when you're not working any longer or not working at a 9-to-5 any longer.
Perfect. Yeah. So if you can't do 10-10-10, Amanda, do you have a stopgap? Could we do something like 8-8-8 or 1-1-1-1 if we had to?
Yeah, for sure. I love 1-1-1 as a starting point because it's really easy to move the decimal over 2 spots instead of just 1 spot to get 1%. Makes the math really easy. And then each quarter, maybe you increase by 3%, maybe go to 2-2-2 or 4-1-1, depending on which need you want or something like that, so that you're moving in the right direction. But quarterly is kind of doable in terms of making adjustments and seeing what you can do.
Fantastic. That's a really smart idea, Amanda. I love the idea of incremental change over a reasonable period of time. Love it. Don't let that 1-1-1 last 10 years, though. That's our only recommendation. All right. Action number 2. Recognize and act on the truth that saving and investing are different. Treat saving and investing different. Notice all of those words on the previous slide said short-term savings, medium-term savings, long-term savings. Only invest money you can afford to lose. And I believe one of our wonderful attendees said that. Literally, I think Michelle. Thank you, Michelle, for that great comment. Invest only money you can afford to lose. Everything else should be saved. Great. Number 3, guys, it's not about cash on hand. It's about cash flow. If you can't save it, if you spend more than you make. So, I think racking up debt like the average American was doing before this virus began was a problem. Again, we were out spending our income even before this market crash. I mean, imagine if we had a big pile of money, we wouldn't need a government stimulus check, right? If you'd like some help on thinking through your cash flow, one of the coolest little tools we found is a free extra month of a software we use called You Need a Budget. And if you go to that link on the screen right there, bit.ly/extra YNAB, YNAB, you'll get 1 month free as standard, but then you get a second month free on us. Very cool. Step 4, and all we get out of it is a free month too. So we're not making bukudols or anything on that. It's just a kind of a free month for both of us. We both win. And you get to budget your money, which is the real win. Number 4 action step. Stop keeping up with the Kardashians on Instagram or any other socials, right? And if it's not the Kardashians, it's your friends and family and the people who are regularly showing you the best and brightest parts of their lives. If and advertisers more and more are jumping on social media to get in front of our eyeballs. If advertisers weren't getting your money from social media, they would not show ads on there. And by the way, the more you're off of social media, the more you benefit mentally and the more productive you are in your life. So number 5 action step, pick up a side hustle or 2 or 3 side hustles. So once you drop social media, that on the averages can free up as much as 4 to 6 hours a week or even more, which you can use that time and all the extra time we don't have commuting right now as we're in our stay-at-home orders as we're recording this. You can use that freed up time, the beautiful blessing and gift of time, to increase your income. Guys, there's a ton of online apps today where you can earn extra money. And no, it's not beneath you. Right now, nothing should be beneath you in terms of earning extra cash if you need it. And number 6, plug your ears when a financial advisor makes promises baked in with average returns. So keep your ears plugged with that. Great stuff. Amanda, anything on these action steps before we move on?
These are great ones. I think, especially to get started and moving in the right direction. I love the action steps we're going to have at the very end too.
Okay, cool. Good. Well, let's keep on rolling then for time. The second part of this webinar, we want to talk about, we did say that the problem was saving, not Wall Street, but we weren't totally telling you the whole truth there, because Wall Street is also the problem. Investing is also the problem. So while part 1 of this webinar, we focused on the amount of savings required to sustain your lifestyle in the future, we also do need to discuss the problem of savings. That part of the equation needs to be addressed. So again, many average financial advisors will say, hey, if you want to play it safe, if you want to get into the market, it's brain dead simple. Just put your money in a no-load, low-fee index fund and index it and invest into it regularly. Pay yourself first. They say, let the power of compounding do its magic. And so if that was all true, why are we seeing studies like this come out? So a brand new study that just came out from bankrate.com as of late last year, 2019, said that 37% of Americans have enough money. Just 37%. So 1 out of 3 of us have enough money to pay for a $500 to $1,000 emergency. The other 2/3 of us would have to resort to measures like cutting back spending, charging it on a credit card, borrowing from friends and family, just to meet the cost of that $1,000 or even $500 unexpected event. So that is, I think, again, a problem. So investing problem number 1, compound and average are not the same thing. So let's talk briefly about this again. So over the last 120 years, they say the market has averaged roughly 10% annually, but that would be 6% from capital appreciation of the stock and then 4% from dividends. So the economic growth averaging 2%-ish since 2000, and the dividends are lower now since 2000 at more like 2%. So most projections are saying we can do about 4% average growth in the stock market, according to where the economic factors are headed. So the chart that you guys should see now shows the difference in real values between $1,000 invested actually versus a compound rate of return of 6%. So, we're looking at 6% return on that beautiful orange J curve, but the true result is that blue line at the bottom. What you actually get is far less than the high, beautiful numbers that they say we should get due to average rates of return. So mathematically, these both give us a 6% return. Let that sink in for a minute. The squiggly line is all crunched up and bottled up. It's like a coiled snake, it's the viper of volatility tied up in your portfolio. The top line, the orange line, is what investors think they're going to get with compound returns. The bottom line is what they actually get. Far less, right? I'm looking at it here, like 1.3 million versus 500,000. That's a tremendous loss over time. So the math problem is the real problem, right? Amanda, tell us a bit more about that.
Yeah. So for me, the way that this hits home the biggest is when we look at pension funds and how many states and municipalities can't and companies also can't fulfill their pension requirements. And it's precisely because of this problem here. Back when they set up their pension, they were shown the orange line, and they've ended up getting the blue line, and they've depended on how much they put into the pension system, how much they need to fund from current employees. They've calculated how much that is based on the orange line, but then when they get the blue line, then that just throws the whole calculation off and has really made the pension crisis what it is.
So true, Amanda. I mean, this isn't just mom and pop investors like us. This is full-fledged pension investment accounts, and that math problem is the biggest reason why I think there's a lot of pain to be felt in the future. The second problem of investing is that variable rates of return will change the game. They will change the game. So what the majority of investors misunderstand when they're throwing around numbers like 6% and 10% compound returns is that losses really matter. And they matter for really two reasons. Number one, getting back to even is not the same thing as making money. And two, the time lost in reaching your financial goals is irretrievable. We cannot go back in time and catch up when we lose even a single dollar in the market. I'd say a single dollar lost that you had to keep is unacceptable. So that's the second problem. The third problem with investing is this myth of dollar cost averaging. Now, I don't know if we've ever talked about dollar cost averaging on our podcast. I was going back to look at it. I don't think I've ever really mentioned it directly on our show. And Amanda, I'm not sure if you guys have.
Nope, we definitely haven't.
Grandma's Wealth. Okay. So when you dollar cost average, what you're doing is you're putting money in every month, whether it's high or low. $500 a month going into that index fund or that brokerage account or that IRA. Just chuck. It's thrown at every 401k essentially is dollar cost averaging. Okay. And so when you dollar cost average, and this is just true math, right? You're breaking the two main rules of investing. Warren Buffett said it first. First rule is don't lose money. Second rule is don't forget rule number one. Another way to say that is don't buy high, never sell low. The idea is never lose money. And the problem is, right up to 2009 in the stock market, we had corporate earnings that were going way off the charts. They were way higher than their fundamentals should suggest that they should be. So, if you look at the next chart, which you don't have to be a technical analyst to understand, just look at the red and the green. So from 1904 up to present day, you can see when companies were undervalued, that would be the green, and it'd be cheap to buy their company, Apple or whatever. And red suggests that they were overvalued. People were overpaying for the stock. And notice the stock market itself was rising and falling alongside those estimated valuations, the CAPE. So even if we didn't have the coronavirus, it would have been some other pin. The problem has been that the stocks have been overvalued since 2009, really, since the last great crisis. In fact, you can see we've even been overvalued since since 1990, really, except for one brief moment in the financial crisis there. So, at the start of 2020, valuations were on par with those on the eve of the Great Depression. That's how high up they were in terms of being overvalued. And, really, it was the 1990s tech boom that went even higher than that. So, guys, it really should not have been surprising that a lot of economists were ringing alarm bells about low rates of return. When the company is that expensive to invest into, when stocks are that pricey, there's going to be a lot of other problems and other weird things happening, like IPOs, like Beyond Meat and WeWork, and what were some other ones that Lyft and Uber? They all went public last year, and their stock prices just collapsed. And some of them have rebounded, some of them have not. So it's during these long periods where valuation looks really way out of whack that investors dismiss it and they chase those returns without looking at the fundamentals. So number 4 investing problem is buy and hold. So again, if we're buying every single month, we're going to be holding that stock. The idea is to hold that 401k, hold that stock for 40 years or until it's time to retire. So a recent CNBC article said that they recommended that they invest that listeners and readers of their article would invest the savings into low-cost index funds. The assumption is that they're going to get, and they used 8% average rate of return. But we're already discussing how 8%, any kind of average return, just does not work out, right? So there's a hidden viper in the market. It's like a snake moving back and forth, destroying your wealth. So let's call it the volatility viper. That volatility viper is going to destroy the financial plans, and it's almost never factored into typical financial advisor portfolio projections. So this next chart kind of gets to what we're talking about here. So, during the really strong trending bull market, investors tend to forget that big, major, devastating events happen. These black swan events, as they're called. So these might be the crash of 1929, the Great Depression, the 1974 bear market, the crash of 1987, the dot-com bust, the financial crisis of 2008, and now this pandemic financial crisis. We're all being written off as we have them as like one-off events, once in a generation, these one in 100-year events that seem to happen every 10 years or so. So you guys, we also got to understand that this is the wealth evaporating fact that financial events have on our portfolio. It's seen here. So Amanda, are you able to kind of walk through this chart and then share a bit about your thoughts on this?
Yeah, I mean, we were looking at this chart earlier about how the real, or the projection, the reddish orange graph here doesn't match up with what actually happens. And particularly when we have to sell, we can't hold forever. It doesn't have to be a global financial crisis. It can be a personal financial crisis. Let's say you have a medical emergency, or you become disabled, or you get divorced, or you lose your job. Lots of different things can happen. Or maybe they don't happen, but you have a very close family member who goes through something like that and calls on you to help them out financially. If you have all your money in the market, you're going to have to sell in order to cover those. You're going to pull the money out of the market unexpectedly, and that could have the same timing as when the market's low, just further making it even harder, right, and even more of an impact. In other words, the bottom line here, there are life circumstances that don't allow us to buy and hold forever.
Perfect. And so finally, number 5, investing problem number 5, your personal returns are going to be less than what you're going to be advertised. So one of the biggest mistakes that we see average financial planners have is assuming that markets are going to grow with that consistent rate of return over time to retirement. And that is the massive difference between compound returns and your real returns. That shortfall is going to be just packed in there, compounded when you begin to add things like fees. Those are huge. Taxes, massive problem in the future. And inflation, which we've talked about some earlier, over that same time frame. That volatility viper, that's just one of the snakes. But then there's fees, taxes, inflation. It becomes a brood of vipers over time. Okay, so let's look at the next chart then, and you can kind of see that $1,000 investment made over 144 years. Let's pretend for a minute that you have a super wealthy great-great-grandpa or grandma who purchased $1,000 of stock in 1871. This would have been big money in those days, right? Way before the average American was a stock market speculator. So during the beginnings of the U.S. stock market, the ultra rich in your family were able to keep that stock. They never had to sell it, and they just handed it down generation after generation. From 1871 until the present day, today, you'd have a real return, not average, of a compound annual growth rate of 9.1%, not too shabby. But your real return, when you factor in inflation, taxes, and fees for that investment, would only be 6.9%. Even if we're able to get in, and so the real actual in your pocket money would have only done 6.9%, even though the not average return, CAGR, would have been 9.1. That's a huge deal. So the average return would have been in the 12% range, right? But then the real return is 9.1. But when you factor in the actual money in your pocket, it's even lower. It's even lower.
Yeah, and this is assuming your family is able to keep this stock and never sell it. There's no life emergencies, no And, like, because index funds, let's say this is an index funds, they don't have life emergencies. They don't have a life expectancy or retirement date. And if your family is ultra rich, maybe you never have to sell those stocks to cover your needs. But likely, if you're watching this webinar, you're a normal person. You need money sometimes for unexpected circumstances. We're human beings. It's almost like the index fund is this Olympic swimmer that's gliding efficiently through the ocean. And when we try to get into the ocean, we don't know how to deal with the currents. We've got baggage with us, and we could never catch up to that Olympic swimmer. The baggage could be life emergencies causing us to buy and sell at the wrong time, could mean paying our taxes on this money, right? We got to pay those taxes from somewhere. It could be the fees of the index, the money manager, and anyone else who handles money. Indices don't have emergencies. They don't have to pay taxes. They don't have fees in and of themselves. So if we're thinking we're going to get the return of the index, it's almost like we're treating the index like the heat index of Phoenix. The index doesn't feel the scorching sun, but we sure do.
That's a good way to put that. Yeah, Amanda. Yeah, the heat index of Phoenix does not feel the heat. Only humans do. Wow, that's so true. So, when we look at the index return of the stock market, that's not the same thing as what you'll actually experience. Okay, so guys, you did it. You made it. This was a big walkthrough of why we were financially infected before coronavirus had anything to say about it. Okay, but we have some things to say about what you can do, how you can take action and financially make yourself immune and antivirus your money. So there are many ways we can approach managing that portfolio of risk and avoiding more mean reverting events like we talk about. So we don't recommend or suggest that you try to time the market or try to jump in and out at right or wrong times. That's not the answer. And I also don't think that buying into the buy and hold myth is going to help, or buying into the myth of dollar cost averaging, right? We've talked about some of the myths of average investing. And guys, you have a wonderful human life that's going to be filled with both successes and tragedies. And, I think it's worth saying nobody gets out of this world alive. So we're all going to go through tough spots. And it's just so interesting that this particular tough spot is globally experienced right now. When disaster strikes in the world markets, and it seems to happen every 10 years or so for the global markets, maybe more or less for your personal situation. Amanda, you brought up some personal financial crisis that you might go through. What are you guys going to do to be ready? That's the key question. We want to make sure that this is the last time you ever experience a market downturn. And gracefully, we've had a rebound temporarily anyway. I don't know what the market's going to do Monday. Nobody does. So let's talk about what we can do. Instead, what can we do to sock away large amounts of cash in things that don't lose money, but only grow on a guaranteed basis? Well, we've got two very solid options. So we've talked about ways to avoid problems. Let's talk about ways we can build true wealth in the midst of very turbulent times. So for the first solution, we say, what we want to do. Okay, so yeah, we're talking about in simplest terms. Oh, Amanda, are you?
Yeah, sorry, I forgot we had slides there.
Oh, yeah. So there's a problem of saving and the problem of investing. The solution is saving large amounts of cash that never loses value, but always grows on a guaranteed basis. We had a client say, Mark, when I realized that I could put my money in something that only makes money, I will never lose money. That's a pretty cool statement, right? So what are those things, and how can we do this? How can we build real wealth? Well, you can save large amounts of cash. One of our options is an exquisitely designed bank on yourself type whole life policy. Of all things, right? So looking at the vast landscape of places you could park cash, this is one spot where you can put regular amounts of money in at whatever amount is comfortable for you. And every year it grows on a guaranteed basis. So the cash in the policy on a guaranteed basis is larger this year than it was last year. So literally no more volatility, no more lost decades. Every single day, every single month, every single year, your net worth increases, right? So when you save money, it's great to dollar cost average. So, again, that word means to save something on a regular basis. But rather than averaging your buying and selling of investments, Instead, just sock money regularly away. I love the habit of monthly savings. The problem is where we're putting that dollar every month. So rather than dollar cost averaging, packing money into a policy on a regular basis makes great sense. Okay, so another way you can understand risk and control the drawdowns in your portfolio during market declines when you have your money in a bank on yourself type whole life policy. And by using a bank on yourself policy type policy, designed the bank on yourself way, it'll be liquid, meaning it'll be accessible cash. So you can get that money within a week, able to pull those funds out, draw against them through a policy loan that'll allow you to weather any storm. And if your retirement does take a beating, your policy won't. You're beating inflation with some of the returns of these policies, and it won't lose value or stop the compounding. In fact, when you access the loan feature of these life insurance policies, the policy will continue to grow as if you had not touched a dime of the money. So that blows me away. But why don't we pull over for a minute? I've said a lot. Amanda, give us an example of what we're talking about here.
Yeah, let's go back to John, the 23-year-old making $40,000 a year. According to the Social Security Administration, he has a 1 in 4 chance of being out of work for at least a year before he gets to normal retirement age, 67, 70, somewhere around in there. And that's true for all of us, right? If we're in those decades from 20 years old to normal retirement age, there's a chance that we might have at least a year where we're not able to work. What would you do if that were you? And if you have all your money in a 401k, you've got a couple options, right? With Bank on Yourself, you've got access to your cash value. You can borrow against it. The policy is going to continue to grow uninterrupted for your future. And then when you get a job start your business or whatever it is you do to come out of that situation, you can pay back the loan on your policy as you get your feet back under you without any loss of compounding. I don't know anything else that can do that.
Yeah, you're describing a form of sanity in the midst of an insane world. You know, if you've got that pile of money, you can make it through an unemployment stretch or downturn in your business. Great. So good. Well, good for you, John, for making that smart choice. As you go through life, headed toward retirement, you're going to have a large cash cushion. You do not want to be forced to draw on a pool of investments when the market is dropping like it is this year. When you take money out of your portfolio of investments while the market's dropping, that's actually like double pain. You can't replace money you withdraw out of your investments. So we do recommend in certain circumstances having a whole life insurance policy equal to at least 5 to 7 years of your retirement money, your expenses, to help support the down years of the market. We don't say don't invest with either me, Amanda, or Brandon. I don't think any of us would say just avoid the market entirely. But what we're saying is have enough money equal to at least 5 to 7 years of your retirement expenses to help support the down years of the stock market, where you can draw on your whole life policy to help recover or wait until the market recovers. And then you can go back to pulling money out of your investments if you really want to. So what we're describing here is called the volatility buffer, which can dramatically increase your ability to spend money and enjoy a very comfortable retirement. You don't necessarily need to have $9+ million if you can use something we refer to, and it's been referred to as the volatility buffer, and reach out to us again if you'd like to talk more about how to set up that strategy. So I wanted to take a look at an example. We promised numbers. So Dan is an actual Bank on Yourself policy holder. And he was doing all the right things, but getting nowhere. His net worth really didn't improve. He started investing in the tech bubble. He went straight through 2008. And really, the net worth went up and it went down and went up and went down. Can you hit the next button and you'll see it. Whoops, we got to get rid of his face here. There we go. So you can see it there. His net worth, he graciously showed us his actual net worth. And basically, it didn't really move. It stayed the same. There's that dotted line showing his average net worth there over 10+ years. Paper gains, paper losses, the housing market bubble and pop. But then move forward one more slide then, Amanda. And in 2009, he opened up his very first Bank on Yourself policy. And from there on, he continued to track his real net worth. And it's nearly tripled in the last 10 years. That's real wealth getting locked in, not paper wealth, real wealth getting locked in year over year. Incredible to just see that in reality. Now, the questions have been, well, what's the light green and the light red? That's him taking policy loans and investing in things like real estate. But even so, the policy itself continues to march upward and onward. So you don't have to choose between investments and bank on yourself policies. You can do both. It's a both and option. So one of the things Dan mentioned was, hey, when you put your money in things that don't lose money, you only make money. Pretty phenomenal, right? This is compounding growth. Let's take a look quickly at the next slide there, Amanda. We can kind of visualize that volatility buffer. So here's someone who has, at age 65, a $2 million IRA. And he or she decides to take $150,000 a year out every single year, regardless of what the stock market's going to do. And due to the market's hypothetical returns, we have some down years, we have some up years, some great ups, some great downs. And in just 15 years, we're down to only $940,000 left. Now that might sound like a lot, but if just 15 years ago you had $2 million and you're already down halfway with less to spend, that's going to start getting you're going to feel a little antsy. Your senior discount coupons are going to be coming out a little more often. So what can we do? There are a few years there where you have a negative market return. The first two, for example, when you're looks like when you're 73, there's a couple in there, right? 4 or 5 down years in that market 15-year period. So Amanda, show us what the volatility buffer can do. Okay, so in those years where we have a down year in the market, we don't take from our retirement accounts, but instead we just pull from our whole life policy, $150,000. And then we wait for that market to return. So in that second year and that third year, we're going to pull from the whole life policy, let the market value of our IRA recover, and then pull from the IRA when we need to, when the markets are up. By the end of 15 years, instead of 900 grand or whatever he had there, instead now with the volatility buffer, he's got $3.8 million, more than what he started with, almost double, more than double what he started with. Powerful, powerful idea. Plus, there's a death benefit at the end of the game because it is life insurance after all. Amanda, do you want to say anything about this?
I think the numbers speak for themselves.
Yeah. Couldn't you take a lot more income out of this if you wanted to? You don't have to have that much money in the IRA or even the life insurance. You don't have to work as hard if you've got this competing and collaborating, I should say, with the investment portfolio, right?
Yeah. Oh, and just to make it clear, this 150 here is pre-tax. So they're kind of saying maybe he has to pay 50,000 in taxes on that, right? Whereas over here, this 100,000 is post-tax. So he has the same amount of income all the years, just to make that clear.
Mm-hmm. Yeah. Very good. Great stuff. All right. Second and final stretch, and then we'd love to have some time for some Q&A at the end. So we've got the fixed indexed annuity. We sometimes call this the income maximization strategy. So guys, this is a strategy we use using a fixed indexed annuity that allows for your cash savings, like brokerage accounts, savings accounts, or if you've got that old IRA, 401k, and need to move it to somewhere safe, and you simply you're tired of assets under management fees, you're tired of market downturns like we're going through this year, the fixed index annuity helps you participate when the market is up, but protects you when the market's going to drop. I know that sounds crazy, but this is something that we do with a lot of our clients. It's not a bank on yourself policy. It's something separate, but it's one of the key strategies we use to help build people's true wealth, real wealth, outside of the market. So I read actually this week in Bloomberg, there's an article on how rich Americans were activating their pandemic escape plans. So these multi-million-dollar bunkers were built in places like New Zealand and Indiana, actually. And many wealthy folks are hiding out inside their bunkers as we speak. So if you're listening to this, if you're a super wealthy dude or gal and you're in a bunker right now, I have good news. We're all still out here. We're still alive. The zombies haven't taken over. By the way, If you forgot your security code, I can get that to you. Just text me and we'll make sure we can get that to you. So, okay, that aside, what I would like to say is that you don't have to participate in these market crashes. You don't have to run to your pandemic escape hatch. You can participate only in the recovery of the market, but not the collapse of the market. So I can't build you a multi-million-dollar bunker, but a fixed indexed annuity with income riders can give you safety, security, with no risk of loss to the market during the downturns, and it can give you increases in net worth with when the market chooses to recover. So the next chart kind of shows this quickly, which is a powerful chart. The red line on this is the stock market, the S&P 500. If you had invested 100 grand in 1998, how your money would have done over the next almost 20 years. Ups and downs, ups and downs. We've seen it today. The market's gyrations. One thing I kind of notice is the year 2000, you've got $137,000, and there in 2013, you've got $137,000. That's almost 13 years gone. Just money just gone. Whereas if you had the fixed indexed annuity, the green line here, you get to grow most of the way when the market's up. Not all the way, but most of the way when the market's up. But when the market collapses, your money stays protected. Look at 2000. Look at 2001, 2002. Look at 2008 and 9. What if we're doing this again in 2020? Wouldn't you want every dollar that you need to have in your retirement future locked in right now in your financial bunker, so to speak? So that's the financial bunker, I guess. But there's one more I wanted to show you, and that is the real life example of a 55-year-old. Oh, this quote here says, our approach to retirement planning is all wrong. We need to think about monthly income, not net worth. That's Robert Merton, one of the smartest guys I'm aware of in the retirement planning world. So it's all about income, not a big fat juicy number on your net worth statement. Let me explain what I mean, then we'll wrap up with some questions. All right, the next chart there shows an example of someone who dumps in 500 grand into one of the fixed index annuities we're describing, and it goes up. No matter what the market does, it's going to grow, and there's that nice peak, and then it starts to come down. That purple line starts to come down. What's going on there? That's this gentleman or gal taking some money out of her account, starting at about $35,000 in the first year. And then each year thereafter, it continues to grow, continues to build. Every year that market goes up, when there's a positive index, that person gets a pay raise. Such to the point, after 30 years, the income is at $89,000, not $35,000, $89,000. More than double, almost triple the original income. That's incredible, powerful concept. It's not about your return on investment. I almost don't care what your rate of return in your mutual funds were. It's about the rate of income. That's my true ROI. Very good. All right. Lastly, remember, guys, your biggest asset is time. The most valuable commodity is time. The only thing we can't get more of is time. So let's make sure that we put the most to our time. And time is the most valuable asset, both for wherever you put your money. Compound money always is better when you're younger, right? And today you're as young as you'll ever be, ever again. But it's also the time we have as an asset for our families right now. Stuck in our homes, this is a great opportunity to get finances straight for the first time. So I am done yakking. I think this is a good stopping point. Amanda, do you want to tell folks how they can reach out to us? And then I'd love to open it up for questions for about 10 minutes, so if we have time.
You'll notice in our shared document that I've got the Q&A queue up there if you want to browse through that to pick out some questions to answer.
Okay.
So this is how you reach us. If you have questions that you don't want to ask in the Q&A or that are more personal in nature, you want to make sure you get those answered by talking with one of us one-on-one. So for Mark, you go to lategrowth.com/schedule. He's got an intro or exploratory call there, just quick 15-20 minutes. You can make sure you get your questions answered, talk about what it looks like to work together, that kind of thing. Or if you don't want to go and like use an online calendar, just call this 1-800 number or email hello@nyafinancialpodcast.com. Myself, Amanda, and Brandon, who is also with us here, you can reach us over at grandmaswealthwisdom.com. You can go /call or just go there and click request a meeting. And there's our toll-free number, 866 in our case. And look, our emails are very similar. hello@grandmaswealthwisdom.com. We'd love to talk with you in whatever way you feel most comfortable to reach out to us. Please do that.
Awesome. Now, I promised some prizes for those that are willing to raise their hand and ask the questions. I see a few people have their hand raised, and B, I see your hand is raised. So if it's all right, I'm going to allow you to talk. Here, I'll push the button here. You are live and able to speak when you're ready. You'll have to accept it, and then you can ask your question. And while we're waiting for that, Amanda, did you see a question you'd like to chime in on that was written in the chat box?
Wow, I'm going back and looking at the early ones because I've got all the later ones in my head, and more are coming in. I'm trying to get to those as well. Oh, I love this question. What happens if you have debt? Should you start saving aggressively if you currently have credit card debt?
Yeah, I'll let you go for that one, Amanda. What do you think?
Yeah, we did actually our Q1 live call was about the same question. We compared the debt snowball method popularized by Dave Ramsey with what we called the debt snowbank method that has been trademarked by the one and only Mark Willis. Invite you to go find that. Brandon, if you could find that link and put it in the broadcast message, that'd be great.
Yep. It's on YouTube if you want to just search for it. Snowbank method. Yep.
Yeah. And we showed how if depending on how much credit card debt you have, what interest rates, you want to make sure you apply this to your unique situation. But we were showing some really practical examples. I remember the example I shared that this woman would have $100,000 more at retirement if she was started saving and only paying the minimums on her debt, and then paid off all her debt at once when her bank on yourself type whole life policy had enough money to just do that kind of transfer. Because of the continuing growth of that money within her policy, her whole life policy, while it was canceling out her debt that she had there.
Fantastic. Yeah, the power of uninterrupted compound growth with the policy allows us to pay off debts. Now, it might or might not make sense for you. Don't know what your total interest rate on your credit card is and that sort of thing. But that's a strategy that does work, and we can do the math on that for you guys. So, B, I see your hand is raised. You are able to talk. Can you try speaking? See if we can hear you.
Can you hear me?
Yes, we can.
Oh, okay, great.
Hi.
Yes, I do have quite a bit of my TSP. So if I would want to put like half of it in this bank on yourself, then should I have like a monthly investment on that? I have several questions actually. But I don't understand how you can withdraw the money and still continue the growth. Like if I take some money out of my TSP, I lose that growth.
Got it. Great. Good question. So Beatrice, the TSP is a government qualified plan. For those not familiar, it's similar to a 401k. And it does mean withdrawing money out of a TSP to put into a bank on yourself type policy to do that. So to get money out of a qualified retirement plan, you have to look at your tax situation, understand the full ramification of things, right? And when you're ready to do that, it would be a taxable event, typically, to take money out of a TSP. Depending on your age and situation, you might be able to avoid an early withdrawal penalty. Guys, some folks may not know, but the CARES Act of 2020 allows folks who've been impacted by the coronavirus to avoid the early withdrawal penalty and to pay the taxes due on that distribution over not 1 year, but 3 years. I've never seen the taxes get delayed by 3 years like this, where you can spread that tax paying out over 3 years. That's a pretty remarkable, and maybe the only time we'll ever see this in our lifetime, especially with taxes already as low as they are.
Is that because of the coronavirus, or?
Correct. Yeah. So you'd have to look into
okay.
the notes there, talk to your employer. But yeah, if you've been impacted negatively by the coronavirus, the CARES Act allows you to withdraw up to $100,000 and put it in without an early withdrawal penalty and by ratably paying your taxes over 3 years. Pretty cool. Now,
Okay, I'll get with Amanda on that then. And
roll.
also, I have like a term life insurance policy that I'm paying a little over $100 a month for $800K until I'm 75. I know when I turn 75, that just all goes away. But how do I know where the break-even point of when I should stop paying for this and go with the help, put that money instead in the whole life versus the term life?
Yeah. Amanda, you want to give that one a try? Go for it. Or you want me to go for it?
You go for it.
Okay. Well, so, again, chat with Amanda for all the details. Sounds like you guys are connected. But I would say, Beatrice, the one thing you might try is looking and seeing if there's a conversion option on your term insurance. It is possible some insurance companies will let you convert term insurance over to whole life. You want to know what kind of company it is. Not all whole life is bank on yourself type whole life, and you can get a pretty, let's just say not good whole life policy at the company. So you want to make sure you know what you're converting to is the key there. But it could be, I don't know your age situation, but you could
63. I'm 63.
So 21 years old. Okay, got it. And so at some point it will make more sense to convert that when your income is enough. You can convert that over to term insurance or to whole life insurance at a bank on yourself company. One more thing, even if you have a term policy from another company, sometimes you can convert it to a brand new company, even without showing that you're still healthy or whatever, which we hope you are. But you can do it without an exam or anything if you've had that term policy for a couple of years.
Okay, I'll get with Amanda on that then. Thank you. You can mute me out because I've got people making noise here.
Hey, no, thank you. Thanks for your contribution. I see another hand is raised. While I get that loaded up, Amanda, do you see a question you want to answer?
Well, there's so many. How about, something we didn't talk about today, totally off topic, but Colin asked, is now a good time to refi a mortgage and redirect cash flow into premium? So Colin, there's a bunch of questions that I would ask, but the short answer, for sure, talk with someone like us, talk to your mortgage broker, and make sure this works out for you. But typically what we're seeing is that refinance rates are right now about 3.5%. So if you're paying more than that, it might be a good time to look into a refinance. Our favorite mortgage guy named Tim has been telling us that he thinks that mortgage rates are going to go up to 5 or 6% by the fall because of all the forbearance and potential for foreclosures and stuff. So that alone might be a good reason to lock in a low rate now rather than waiting a little while. And then that could actually give you the opportunity, like you're mentioning, you can take the difference in the savings that you have there and redirect that into premium on your policy, assuming, I'm guessing you have one already. That could be a really great way because then you get that money growing for you that could have been just trapped into the walls of your house. And if you ever need to, let's say something really bad happens, you can't pay your mortgage, you can actually take that money out of your policy and go pay your mortgage for you. And isn't that even better than being ahead on your mortgage payments or saving a little bit of interest? For that would be the kind of line of thinking I would take with that question. Anything you'd add, Mark?
No, that's really, really well said. Really well said. Okay, well, we need to wrap up. So one or two more quick questions. If anyone has anything, now's your chance. Now's your chance. We've got Terry, who's I've let you speak. If you had your hand raised, so I've let you speak, but you have yet to accept it, Terry. So if you want to say your question, now's your chance. While we're waiting, then I will read one more question here. Oh, it looks like you are self-muted, Terry. So if you want to say anything, now's your chance, but we'll pass on if we don't hear from you.
He lowered his hand, or she.
Okay, great. Okay. So last question I'll bring up here. Someone asked the question, Does it ever make sense to take out a bank on yourself loan and purchase an annuity? Well, that's a great, smart question. I would say, you're thinking right. You're thinking about how you can let your money do two things at once. I don't know. I guess we'd have to run the math on that to really be sure. There is some risk there, right? Anytime you take a policy loan, you'll want to have a good strategic way to pay it back. But you can do something that's maybe a little simpler than this, and that's something called a 1035 exchange. Amanda, do you want to share what that is and how folks can take advantage of that?
Yeah. So anytime you have cash value in a life insurance policy, you can transfer that to an annuity. It's a non-taxable transfer. It's called a 1035 exchange, and it buys the annuity, which then could become your passive income, shooting out money for the rest of your life. Annuities and life insurance have that by law, that they have to always have that option there for your cash value. You do lose some death benefit when you do that. So that's where you have to weigh the pros and cons of, do you want to keep your death benefit high, or do you want to make sure you've got lifetime income that could go up as the index goes up, which is more important to you at that time. But that's actually one of the reasons I love that I have a majority of my money in life insurance right now, because I know that I can always transfer that to an annuity if that became an important thing to me.
Yeah, that's right. You're keeping your options open with the life insurance today, Amanda. You can always convert 2 or 3 of your policies in the future over to an annuity that generates an income you cannot live. Super smart. All right, guys, we're going to wrap up. And I'm really impressed, really proud of all the great work you guys are all doing. I know some of you are brand new to our world, so welcome to the revolution. There are better and more satisfying ways to prepare for your future. You don't have to. It's not written anywhere that you have to put your money in things that you cannot predict or count on, control. You're able to antivirus your money. It is possible. You can give yourself financial immunity from anything that comes next. Whatever comes down the pipeline. And nothing in life is ultimately guaranteed, I suppose. But as far as the financial world is concerned, I can't find anywhere better I'd want my money to be than in the solutions we've talked about together today. So again, we're ready. We'd love to be a part of your financial antivirusing. We'd love to help run that program for you. We'd love to help sit down and settle in on a strategy that you can count on for the rest of your life. It's one of the great joys of our work. So Brandon and Amanda are ready. I think you guys might even have time this week or next week that you've opened up as a result in preparation for this webinar, and myself too. So the links are on the page here, how to reach us. Go to grandmaswealthwisdom.com/call and lakegrowth.com/schedule. And we'd love to be your guides and helping you guys set up a PPE, some personal financial protective equipment to help you from whatever comes down the pipeline, financially, health-wise, and otherwise. Everyone, are going to wrap up here together today. We'll send out the announcement of who won the prize, the $100 Amazon gift card for the live. I guess I can go ahead and say it. B, you win. Great question. We'll send you the gift card after this to you. So keep your eyes open for that $100 gift card, and put that into an investment earning 8% average annual return. You'll have a $10 million, I think, right? According to Average Annual Advice, right? So thank you everyone for being a part of this together today, and we look forward to being a part of your financial future. Have a great rest of your day and happy Saturday. Stay safe.
Thanks, Mark.